Today we're backtesting selling LEAP call options on Meta. You'll see the results of selling long-term call options since Meta's IPO 12 years ago. For those that don't know, LEAPs are long-term options with an expiration of roughly 1 to 2.5 years in the future. Why would you want to do this? Meta and lots of other stocks have been on a big run the last few weeks. Lots of shorter covered calls on Meta are in danger of getting called away. If you're in this situation and you don't want your stock to get called away, you could consider rolling your shorter term options out and up, which means out in expiration and up in strike price, possibly all the way out to LEAPs, 1 year or more. But only if you want to hold the underlying Meta for a long time and you think the underlying Meta is still undervalued. So we're going to backtest this strategy and see if it's been worth it, selling LEAPs on Meta in this particular situation. There doesn't seem to be much discussion about selling call LEAPs. So I'm going to scratch that itch and backtest selling Meta or Facebook LEAP call options. We'll look at LEAPs from the June 2012 Facebook IPO through August 2022. As you can see from this chart, Meta stock had a really nice run from its IPO in 2012 through August of 2021, then went through an extended downturn. It's turned back up since, but that's outside of this date range. So we can guesstimate that selling LEAP call options over most of this time frame has done badly. Selling calls on a stock that continues to go up is going to result in underperformance of just holding the underlying. But let's see if we can find something in the results of the backtests to use in the current situation and see if it may be worthwhile to sell some LEAP call options on Meta if you have covered calls in danger of getting called away. First, we'll look at breaking down the LEAP backtest results by days to expiration and then by delta. Here's a bar chart showing the results of 11 backtests. Each bar is a backtest of Facebook call LEAPs for a given range of days to expiration. For all the LEAPs it found in the data from 2012 to August of 2022. For example, the leftmost bar, this one right here, shows the results of all LEAPs having days to expiration of 300 to 320. The LEAP options lost about 1.4 cents a day, or $1.40 if you multiply it by 100. The second bar, this one, is for LEAPs having days to expiration of 321 days to 340 days. They did the best, only losing about 0.4 cents per day, and so forth. So what can we conclude from this chart? Not much, in my opinion. Maybe the shorter term LEAPs lost a little less on average than the longer term ones, but as we speculated, they all lost. There doesn't seem to be anything very notable about this chart. We'll take a look at breaking it down by delta, and something more interesting will emerge. Here's the chart breaking it down by delta instead of days to expiration. The values on the x-axis down here shows the increasing delta values left to right. One thing I forgot to mention on the previous chart is that each bar represents a backtest having approximately 1,000 LEAPs, each having a unique start date, strike, and expiration combination. So this chart tells a far different story than the last. There's a clear trend going on here. Lower deltas did much better than higher deltas. All the backtests still lost, But the lowest delta, this guy over here, was practically break even. You wouldn't be able to collect as much premium with the lower deltas, but you get to participate much more with the gains in the underlying. So what can we conclude from these charts? First, this isn't financial advice. I'm not a financial advisor. Do your own research. These leap call backtests were based solely on how Facebook Meta did over this time period. So it's a fool's errand to try and read too much into these results. However, it shows that in this particular set of data, if you are wanting to roll out your covered calls into leaps to avoid getting called away, low delta leaps were the way to go. Keep in mind the consequences of doing this. You'll no longer be able to write covered calls monthly or weekly as long as your leap is open. If the stock goes down, you might have the opportunity to roll it down and in. Roll to a lower strike and a more recent expiration. Lower delta leaps mean you won't be rolling for as big a credit, or you may even need to take a small debit to get into the strike and expiration you want. Don't do this if you want to keep collecting premium short term, or if you don't want to hold the stock long term. That's it. Hope you found this content useful. If so, please like and subscribe.